Good morning. This is Marvin Appel of Systems and Forecast Newsletter here with Jay Soloff of Investors Alley at the Chicago 2018 Traders Expo, part 2 of our interview this morning. Thank you for being here again.
Thank you.
We did some talking about how you recommend a portfolio of options positions. You prefer, in general, selling volatility and not necessarily being delta neutral because of the demands that makes on the capital you have to commit. I'm wondering if you have a preference. Well, I mean, basically what you said would suggest you have a preference if you're doing spreads for a credit spread rather than a debit spread. Is that true?
Generally speaking, yes. Although there are certainly times when the volatility environment is such, so let's say extremely low volatility, where the risk of selling a credit spread is just not worth it, and you might as well find a really cheap debit spread and have, if you have a directional opinion on something. I'm just saying, don't just go buy a debit spread, but if you have a strong thesis that leads you to believe something is going to move in a certain direction and volatility is cheap.
Well, volatility has been cheap for a very long time, with the exception of a brief spike in volatility early this year. Would you say volatility is too cheap to be selling it, or do you find opportunities even with VIX in the 12 to 13 level?
No, there are definitely opportunities, because while market volatility may be low in general, you still have entire volatility regimes for all different stocks, commodities, everything has got, particularly with ETFs, and you have access to just about any asset. Yeah, there's almost always a volatility worth selling. It has to be pretty extreme. Like back when VIX was under 10, then it was very difficult to find volatility to sell. At 12, 13, there's almost always opportunities to find volatility worth selling. Doesn't mean I would sell, let's say, volatility on the S&P 500,
right?
But you can, particularly during earnings season like we're in now, there's almost always opportunity.
Okay, so earnings season you view as like a ripe climate for finding things. You want to get into those positions before the earnings release?
Sometimes before, actually a lot of times after. You'll find maybe some overselling takes place based on, maybe the earnings were for a stock. They might be good and the company is still in great shape, but maybe just not what people expected. And so it'll be a sell the news sort of situation. And because they're selling, bumps up volatility. But you might believe that this company is perfectly fine, and once the people who sold the news get out, it'll go back up. So that's a really good opportunity to maybe sell a put credit spread, underneath where you think it's not going to go, down to that point.
Right. And when you evaluate individual stocks as candidates for options positions, do you rely on fundamentals or mostly on technicals?
I look at both. So I mean, it sort of it a little bit depends on how if you define sort of volatility metrics as technicals. I'm definitely looking at that. I'll look at charts to some extent, but I'm not really a chartist. I will definitely look at fundamentals in the sense of, all right, this company sold off on earnings. The news is bad. The numbers are bad. This stock was already overvalued, and it's still over. Something like that. But it's not like I'm necessarily digging into a balance sheet and looking at the makeup of a long-term debt or something like that.
Do you have a rule of thumb, since you're selling volatility? Do you have a rule of thumb of when you close out a trade? Like if you achieved X% of the maximum profit, do you have a rule of thumb to suggest for the listeners?
Yeah, definitely. I don't like holding to expiration. There's too much risk. So let's say I'm getting a credit of around 70 cents to $1. It's kind of the range I'm usually looking for in a 30-day trade. I usually close out when it gets below 20 cents. I think, sometimes it's a little more, sometimes it's a little less, but 20 cents is kind of my level. I want to make around 50 cents or maybe a bit more on a given trade. So if I get to that level and it happens pretty quick, I'm going to close out and move on to the next one. If it's right around there and things are pretty calm, I might hold it a little bit longer, but that's kind of my rule of thumb.
You mentioned that you can find pockets of higher volatility to provide the grist for your options trades. Do you find that high volatility stocks, like the high flying growth stocks and such, are those better for your kinds of trades, or are they more dangerous? In other words, where's the best risk versus reward in your experience?
That's a good question, and I think it kind of depends. Sometimes the high flying ones are really good, but you don't necessarily I don't trade something like Tesla. It's too much, right?
Right.
But maybe something like Nvidia or something like that. That's generally a good company with a bright future, but does still have higher volatility. That's the sort of thing I like to trade. So you don't want to go necessarily with a utility, but you don't necessarily want to go with Tesla either. Somewhere in the middle.
Okay, we are out of time, but for the listeners, can you tell them where they can get more information about your option services and other products?
Thank you. Yeah, optionsprofitengine.com is the website for my primary newsletter and trading service. So feel free to go and take a look at it.
Well, thank you very much, Jay, and thank you for listening.